So we have a panel here which is between the malls, the shopping centers, and retailers. And obviously that love and hate remains because we need each other in order to kind of grow from where we are today. And this particular session today, I'll kind of divide between the two panelists on the shopping center mall side and on the other side, the retailers. The session headline is trading density versus ROI. Okay? So one's the top line, one's the bottom line. And I'm going to just go alphabetically. So Akash, before you, I'm going to start with you. Okay. So Akash has done F&B, and Akash is now in lifestyle, and you can probably have to introduce yourself. But I'm going to come up with an ROI question to you, so just introduce yourself till then.
No, I think for a mall, when we try and open a store, I don't think it is ROI versus...
I didn't ask you a question. I said just introduce yourself. Introduce yourself.
In a hurry to wrap
quickly,
up the session.
Quick introduction.
Okay, so I'm Akash. I work with Raymond. Done F&B all my life, 14 years with Starbucks, KFC, Jubilant, and into a vertical that is pretty new to me, but I'm trying to learn fast. And today I'm here to represent Raymond and share my views. Thanks.
Okay, super. So from a Raymond perspective, because you were to the F&B QSR, I'm just going to talk on Raymond front. Lifestyle, kind of, let's say, semi-luxury brand. So a lot of malls want trading density. Trading density is also vanity metrics in any case. But if they're looking at trading density, one of the ways to get the trading density is to get a lot of footfall. And that happens usually while bringing in, let's say, more value brands. Okay? It's easier. You get a value brand, get a lower price brand. I won't call it cheap, but let's say lower on value. And that brings in the trading density. So from a metrics point of view, they get really good trading density. How does Raymond fit in? Because obviously what you need is higher return on your investment, but also higher AOV or whatever cart size that you would look at.
So I think 3-4 things that we would look at in a mall before we open. One, the kind of conversions that we have. So we are a very high conversion brand because people who come to our Raymond definitely know what they intend to buy. For us, getting into the value side, if you get a brand which is super value, at times people would get sprayed. So my only thing is that if you really want to have those value positioning brands, create a zone in a mall where people would naturally not go, and then you separate those people. The same set of consumers could be coming in to buy lifestyle one day, the other day they could be buying value. So one important thing would be do not place those brands right next to all those bridge to luxury or mid-premium or premium brands. That would help us survive this thing. The other is that, I don't think it is between the ROI and the trading densities. ROI would be important because I have to take a salary and the shareholders' wealth has to be created through that. So they are internal stakeholders for us. For malls, I understand it would be super relevant now that some of them are going for REIT and valuations. Do both, but try to make sure that one doesn't hurt the other and try to strike a very critical balance between the two. Create footfalls, but then make sure that your footfalls do not cannibalize each other.
Okay, good. So I think Arif, again, another retailer looking at gourmet products in terms of hospitality.
So
Obviously,
I'll
introduce
introduce
yourself.
myself.
Yeah,
I'm Arif. I'm an ex-Nike, ex-PVR, ex-Aditya Birla, ex-Manevar. Currently joined Bharti Group's food business. And coming to the core question, I have a very different perspective. I think it is not about ROI or trading density. It's about the life cycle of the brand in question and the mall. So at various stages of the mall, you should have a different strategy. You have a growth phase, saturation phase, and probably decline phase. Similarly, the brand also has a life cycle, and the brand has to choose between a footfall and an ROI question. So it all depends on where you are and what is the timing.
Where you are in your journey.
Yeah, for both the retailers and the malls.
Okay. Madhur, you own the mall, right?
Yeah.
Amravati, Maharashtra. Now that's what you would call it, what, a tier 2 or a 3? Where does it Amravati
tier
fit?
3 city.
Tier 3 city. And how did that happen? Like, how can a mall come to tier 3 city? Like, it's been there for a very long time, but how did you think of a mall when it's a, let's say, traditionally high street market?
So, hi, I'm Madhur. I'm the Executive Director of Tapadia City Center at Amravati. So, we conceived this project because what we saw is that for a city to, develop itself, get in more investment, and also we were seeing that, the younger generation was moving to the metros. So what is there for the city to offer to these people so that they can come back and stay in the same city? That is very challenging, very relevant for all your tier 3, tier 4 cities. At the same time, you see that there are so many, there are a lot of kids and there are no parks, there are no places where they can go for their engagement. And making a mall is not just about making a shopping center, but it's more about a place where you have celebration, you have learnings, and you have engagement together as a community, and everybody comes together. So malls are the new mandirs for for tier 3, tier 4 cities specifically. So that's the reason we built this, because once we built this, we got 74 brands in the mall. We got a lot of appreciation the way the designing and this branding and the zone mix was done. And because of this, we have seen now that there is a pipeline of approximately close to around a lakh square feet of retail space to be taken where brands are interested. The right size of high street or a mall is not currently available.
Okay. So, over to you, Munish. Mall side, right? Okay, great, super. I needed a mall guy also, another mall guy. I had 2 retailers, 1 mall guy. So, trading density or vanity metrics. Coming from a perspective of trading density, first introduce yourself, and I'm going to
I am
ask you a
Munish.
challenging one.
I manage the revenues of Express Avenue, Chennai. My role is basically to maximize revenue, both from a customer perspective and the mall perspective. So we really look into the aspect of trading density very, very closely. Now, trading density is a function of 2, 3 factors. One, what is the kind of customer experience the brand is offering? What is the kind of product relevance they have? Because a lot of times the malls bring the footfalls, but are they brands able to convert them? Which is a function of, are the brands working on the customer experience, their store operations, their merchandise, their visual merchandising? So that is the continuous exercise which the brands need to do. From a mall side, what we need to ensure that we get the relevant brands, how vibrant we are able to keep our shopping centers. Are we doing the correct kind of zoning, having the right neighboring brands, having the brands which are really trending in the market and a part of the center? Because when we are talking about revenue maximization or optimizing the revenue, it is a function of trading density, how the brands are able to generate sales per square foot from the shopping center. And that really encourages the malls to work on their financials.
If you're looking at revenue per square foot, which is like, let's say, overcrowding from a revenue perspective, how does the ROI fit in for the retailer? Obviously, for a retailer, the ROI is a very important part. Apart from, the mall also needs an ROI, but the retailer can only sustain. The mall has the capital, has the land belongs to them, the mall belongs to them. And obviously, you have a REIT coming up, you've got all kinds of ways to monetize it. But where does the retailer go from an ROI perspective? If you're so focused on square foot revenues.
See, from an ROI perspective, like in the earlier sessions, we were talking about the occupancy cost, how we can keep the occupancy cost in a certain range. Because if the mall is going to increase the occupancy cost, and the biggest contributor for a brand in the cost structure is OC. So if we, as a mall, we are able to keep the OC in a certain range, that helps the brands to maximize their ROI and also encourages them to work on the overall consumption.
Got you. Okay, fair enough. And do you do this with the brands that are there in the mall? Do you do this as like a dialogue or somewhere like, do you do meetings with them on this?
So basically what we have started doing, we have started tracking the brands on a monthly basis as to are they able to show like-to-like growth over the last last year. So when we are working with the brands in a very collaborative manner, we are also able to identify which are the brands which are not able to generate enough sales from the footfalls which we are generating. Then we have also come up with the concept of PIP, which is very relevant in the corporate, is the performance improvement plan. If the brands are not performing, we put them into the PIP, and what happens is a function of PIP, there's an external pressure and the brands start performing. So it's a very equitable relationship with the brands where we are able to work with them in a collaborative manner, where we go into the extent of now we are analyzing how many stores in the mall do not have a store manager. how many stores in the brand, they have merchandising issues. Because of which, even if the mall gets the footfall, the brand is not able to convert.
The experience is poor then, yeah. Got
Yeah.
you. Okay, super. Rakesh, while you introduce yourself, I'm going to...
Hi, I'm Rakesh Ajila. I was into food industry for almost 18 years, like with Cafe Coffee Day and Jubilant. Created a market, and since 7 years, I'm into fitness. So that's how my journey went in. So thing is, I take care of Cult Fit expansion for India, and all the verticals like fitness first we have, and Golds, Cult Neo, and Cult Sports also. There's a new EBO stores we're coming up with the sports apparels and fitness things. And also we have Cult Play, which is actually sports complexes. So we are actually sports clubs we create in various places. That's how it is coming in. And one more format called Sugar Fit, that diabetic reversal formats.
Okay,
That's the
super.
things, yeah.
So making India fit.
Yeah, so see, coming to in my case, compared to all the other panelists here, we are actually culture unfit to malls because we are into fitness. Our function starts at 6 in the morning, so automatically the access and operation issues are there, but still we have good outlets in various things. If you ask me the entire preference of the current opening, if I'm opening 300 outlets per annum, maybe around maximum 78% is going to malls. Especially good point is now 2-tier, 3-tier cities are actually, they are planning more planned, organized fitness centers like zonings in that case. Otherwise, I was always placed into some corner of the food court, otherwise somewhere. And a lot of safety, security issues were initially there in the morning hours and all the things. And ROI calculation wise, if I see, it's not very sustainable to fitness as of today, because now the trend is changing. Today morning we saw some sessions here where the new mall developers are telling that they are creating separate zones and all the things. That will help. Actually, otherwise today ROI versus actually is not working in our case. Thing is, parking charges are different, and also the timings of the, when they reach to the zone, it becomes a problem. Operation hours early morning charges are different. CAM is different. So automatically the loading was very high. That's why our expansion, we focused more on the mid-level and below segment into the high streets. That made more sense to us.
So,
Yeah.
so very quick question on high street to malls, or let's say shopping center. What's the division between high street and malls? Let's say you have 100 of them. What's the division of that?
It's very sorry to say, like maybe 6 to 7%.
6 to 7 is in malls.
Malls.
Yeah,
And all the high
yeah,
streets.
okay, fair
yes.
enough. And
That's
do you
the
make
things.
more ROI in malls or not? Like apples to
See,
apples?
thing is selected. Premium formats like fitness first will do.
You'll do,
Yeah.
yeah.
But when it comes to the mid segment, is not doing that
Okay,
great.
fair enough.
Neighborhood malls actually really helps because
Okay.
my footfall is different.
Sure.
Become neighborhood is more dependent
Sure.
on. Otherwise, it varies. That's
Got
what
you.
it is.
Super. Okay. So, Sanjay, you're the new kid, technically from the Kopi Kanagan point of view. I met with Edward. He was in India. Yeah. And I told him to open their own office here. It's better, don't go with somebody else. But anyway, I was quite impressed. 35-year-old guy comes in from Indonesia, has lunch, just wanted to explore with many people that he was meeting. And I just saw that he had 960 outlets in like 60 cities in Indonesia. 960 outlets of a coffee brand. So Sanjay, I think you're going to take care of their expansion now?
Yes, absolutely.
Okay.
I think Edward listened to you and he decided to open a 100% FDI subsidiary. That's where I came in. So, and I'm heading the business of Kopi Kinangan in India. So right now, a lot of work is happening at the back end.
Yep.
We do not have a store as of now in India, but then it has about, like you said, 960 in Indonesia, in total 1,100 stores in Indonesia, Malaysia, Singapore, and very recently Philippines. And India is the next big market we are planning to enter. It's a brand that has really made waves, at least in the South Asia world. One of the fastest growing actually cafe chains in the world itself. Very, very excited to be here. Personally, before this, I was working with Jubilant Foodworks. I was heading their international business. So I've set up the Bangladesh business for them right from scratch, where today they are the leaders. And Sri Lanka and Bangladesh, what I was actively managing. Before that, I was in food and beverage side, which is Nestle and Tata Consumer. So that's a bit about my background.
Wow.
You had a
that's
particular
great.
question?
No, that's awesome.
Yeah.
The question is, obviously, you would have you've seen all the malls, and you've seen malls in India, shopping centers, but you also seen the international market. You're obviously now part of an international brand entering India. So the kind of trading density and other metrics that we use are normally on global standards, because obviously, do you think we should have a local standard here, like which is relevant to India, and not like, for example, now they're making out shoe sizes which are relevant to Indian foot, and even clothing. You know, NIFT is doing a study on making Indian clothing size. So I'm saying from that perspective, do you think India needs their own standards, or should we just follow whatever the global standards are, or
absolutely,
the West?
absolutely. India is a very, very large and a very, very complex market. very, very different market. And thereby, I think every person in the value chain needs to have a certain way of operating. To give you an idea, for example, Kopi Kinangan, when it is entering, we are also creating blends specific for India. We are creating food which is specific to India, not just copying and pasting what has already been successful. And like that, like you said, on the mall side, obviously the expectations, the calculations, they all have to be relevant to the audience as well as the person who's leasing the store, right? So like, it is like, since the debate was trading density versus ROI, it is like a marriage, right? So a marriage cannot be successful if both partners are not happy. There is never a marriage where the husband is happy, the wife is not, but the marriage is still successful. It doesn't happen. So you need both sides to have the right kind of mix. I think Akash was leading towards it. So there is a certain trading density that the retail has to commit to. We have to commit to those conversions, those operational standards. We have to give the best to the consumer who walks in, and the mall has to ensure that there's a lot of consumers who walk in, right? But then if it doesn't make sense for the ROI, howsoever great the brand is, howsoever deeper pockets you have, it will never, ever, ever last. So thereby, I think it's not one versus the other. You need to do both. But to come back to your question, it needs to be, the benchmarks need to be right. Success, it's very important to define what is success for the trading density, what is success for the ROI. अगर वो starting में definition goes haywire, then again, it becomes a different discussion.
Fair enough. Okay. Neeraj, while you introduce yourself, I'm going to pop the question for you.
Thank you, Rahul. Good evening, everybody. My name is Neerav Sejpal. I represent the RP Sanjeev Goenka Group. I head the business development for our two retail brands, which are Spencer's Retail and Nature's Basket. And I work with companies like Future Group and Yum Brands. I was with Pizza Hut for nearly 8 years before I joined Spencer's.
Okay. So, the malls obviously want good trading density. They want the best per square foot sales. They want all that happening because obviously that's the metrics they always look at. Now, isn't that nudging brands like yours, the kind of group that you represent, towards, let's say, I'm going to shut this physical store, offline store, and go online? Because you're an online too. Some people cannot be on online, but you have an online business. So do you take that decision that I'd rather be a dark store servicing that particular consumer base, but I don't want to go through this whole fight towards trying to make rents for the mall? Your revenues, their revenues are coming from your rents.
Sure, that's a good point, Rahul. But I think I have a different angle to this entire thing. To answer your question first, I don't think we as retailers or hypermarkets who've been around for such a long time, right? Spencer's has been around for such a long time. And Nature's Basket earlier used to be with Godrej, and then we bought over the brand from them in 2019. Now, the brick and mortar space, even for grocery, I think is here to stay. I don't think we are going to go down the path of only opening dark stores, because I think that space is already taken by the people who are already in the market and who have come up in the last 4-5 years, right? And we know how they're doing, right? So we are very clear that we will keep opening brick and mortar stores, and we will also focus on delivery. And in all of this, if it means we open a few dark stores where in pockets which we feel are going to be heavy delivery centric, then we'll definitely do that. But the point that I was actually making, and in a way I tend to agree with one or two of my co-panelists here, is I think both trading density and ROI are absolutely linked to each other and absolutely important for the retailer as well. For example, when I actually look at a new property in a mall, right, I look at my P&L from a trading density standpoint and a ROI standpoint, right? And the aim and the goal given to the team is how to actually increase the TD to a certain level which will help me reduce my ROI and pay back to a certain period that will make my store profitable in those many given years, right? So I really don't think it's one against the other. As much as the mall is wanting me to increase my trading density, I bet you that we want to increase our trading density as well. There is no question about it. If I start a store at 2,000 rupees a square foot, I have a plan to get it to 4,000 in the next 3 years. I do not want to be happy with 2,000 rupees a square foot, right? Being a hypermarket, I do actually, attract the footfall. But my goal is to increase that TD to wherever it can reach in the given span of 3 to 4 years. So I think it's just totally interlinked. And I'm with the mall guys. where I do have a little bit of a different opinion on the PIP scheme that Munish spoke about, but I'll take that with him offline. But yeah, otherwise I think both are totally interlinked, and even we are more than happy to see to it that our TD keeps increasing and doesn't stay stagnant for sure.
But you also own malls, right, as a group?
Of
So-
course,
Yeah,
of
that's
course.
fine.
There's
Fair
no
enough.
doubt about
Fair
it.
enough.
There's no doubt about
So you have hands in both the jars.
Absolutely,
Okay.
yeah.
Akash, one technology-driven question to you. So you have made to measure in Raymond, right?
Right.
You go and measure yourself. So obviously you need a good storefront. You can't have a made to measure in a kind of a gully or somewhere. So you need a good mall. You go there, made to measure. Somebody gets that. It goes technology-driven. All the measurements go in, and then that shipment goes directly to the consumer. Let's say, how does the mall loses out on what they've actually given you? How do you balance that out? Because you're getting the ROI, getting the customer who's a high bespoke, high spender, but the shipment's directly going from a factory to the consumer.
Okay, so let me clarify. When a consumer comes to a made-to-measure store, the billing happens right there.
Okay, fair enough.
So the mall
bills.
gets
Okay,
to know how much revenue we've done, and then there is a revenue share, so he gets the benefit.
sure.
Obviously, on the technology front, MTM is a little high on tech brand where, we take your body measurement, but then we open an assembly line to make one suit for you
Sure.
the way you get a ready-made. So you get the finesse of ready-made, but your body type.
Got you.
Nobody doing that right now. Probably a couple of brands have just started it, but I think it's a great concept. But obviously, we need the right store for that. It's a very niche brand. We sell suits for 1 lakh, 1.5 lakh. Some of the top people in this country wear a Raymond made to measure. So we need to have our stores at the right place with the right frontage, right visibility, and we need a lot of support for these people to come and see the store. A lot of people would only come to a mall, go to an MTM and go back.
Sure. Got you. Okay. Arif, certain brands that you're bringing in and you already brought into India, really, let's say bridge to luxury and let's say on the higher side. Now you're coming in late, and when you come in late, you obviously have very limited space to go to, because India's paradox is we have first world rent and third world sales. So that will always remain, and you never had quality space. So you'll always go to that place in Gurgaon, you'll go to that place in Delhi and all that, where you'll go because you want the mark there. Now, because you're coming in late and people who came in early got the benefit of the rents, how do you manage that? Because obviously you will charge the consumer more than probably other, let's say, peers or your competition would do. How do you handle that? Or you're going to just forsake your ROI to start with to build the brand because the brand's new to India? It's a popular brand outside, but how do you filter that, right? How do you balance that out?
So we have a bouquet of brands. So if I talk about a recent launch at Mall of India, DLF, so that's a PF Chang store. So we opened the store with a very low profile. We could place our horses, which is our trademark, outside the mall and inside the corridor. And within probably minutes of opening, it was full house. There was no invitees. So some of these brands are very aspirational. People keep traveling to Dubai, to various places. And if you go to Mall of Dubai, we are on the ground floor atrium amongst the ultra luxury brands. And there's always a queue at PF Chang. So it's an Asian American destination. And so since we have multiple brands, every brand will have a different strategy. So obviously, without being arrogant, we are not running after malls. It's the other way around to get the PF Changs.
Okay.
And one success story at Cyber, Hub and Mall of India, and there's word of mouth and, conferences like this, and we are done. So we can easily open 15 to 20 or 30 store. With Pizza Express, it's a different, thing, different journey. We are expanding fast, People don't understand gourmet pizza yet. For them, sorry to say, it's always, Domino's.
No, they do
Pizza.
understand. Now you look at the
So
gourmet pizza as the
once
biggest one.
Now
They do.
they're,
Yeah.
since exposure is there,
Yeah.
they understand it,
Yeah.
and they realize the difference in taste and overall experience. So, like I said, we are getting some very big brands from US now.
Sure.
So we'll have, Bharti. It's a group which has its own might.
Yeah.
So it's a matter of time. Casual dining is going to, take
It is the
over
number one, yeah.
most
Yeah.
prime space in
Yeah.
every mall.
Sure.
And I'm an ex-PVR, so
Sure.
I've seen that
Sure.
journey.
Sure.
And I'll be happy to see the growth of
Sure.
CDRs very soon.
Got you.
Thank
Okay. So Madhur, again, tier 3 Amaravati, obviously you build them all for some reason out there. How do you attract the brands? Like in the brand cycle, let's say PF Chang's, Amravati will be probably 100 years down the line, maybe, hopefully. So I'm just saying, how do you attract the brands? I'm saying one is you go for value brands, you go for the kind of a price sensitive marts and stuff. How do you get people there? How do you get brands to agree to come to Amravati? Because I'm getting into tier 3 myself, and I just want to know, how does the mall help brands like us, which are very mall friendly brands, to come to malls in tier 3?
What we did is, it's very important to build relationship, and you have to stay relevant. You have to tell your brand, what is your perception, what is your perspective of the mall, what will that mall deliver for the people of Amravati or anywhere else in a tier 3, tier 4 city. You would see that, the aspirations levels are very high in smaller cities, and these people in tier 3, tier 4 cities generally go to malls, when they generally go out for their holidays. So before holidays, I have seen people actually stopping by to a nearby larger city, shop from there, and then go for a holiday. So the idea is basically, so say for example, I'll tell you about Amravati. So Amravati, in Nagpur, there are 25,000 Pantaloon customers who were from Amravati, and these are the details which you get to know, and these are the details which the brands also get, that this is the pin code, this is from where people are coming and shopping, and that's give them as an indication that whether there is latency present in that center or not. The second important aspect is that once you've got a brand on board, it is also your duty that that brand makes that sale, and what is important for it is you giving them the right feedback of what is working, what is not working, whether they have the right store manager, whether the franchisee is right or not, because a lot of time we have seen that a good brand with a wrong franchisee is not a great result, and that's a wrong story. So it is very important that the brand also chooses the right franchisee who's going to operate it. And it is very difficult that in a newer city, the retail employees are not are not present at all. It is very difficult. When we opened Tapadia City Center, we had 70 brands, but the journey is very difficult because you do not have the right talent in that city. So you have to develop that. We have recently started this development where we are going to train the store managers from the mall side as well, so that it is good that they stay in the city and they also grow, because the mall can bring in the footfalls, but the conversions have to happen inside the store. As one of the panelists definitely mentioned, you have to look at the VM, you have to look at the store. Recently, one store did great business, but it was only half full. The franchisee was not concerned whether he has stock or not. So this is very important. In a smaller city, you have to work together a lot more with the regional manager.
But okay. Munish, like you mentioned about performance. Now, is there a pressure to perform to your retailers where, like you're talking about, you're going to do performance incentives, or basically incentives not there. The incentive is just either increase your sales or get out. So would you like those churns to get the guy out who's been with you and he's for some reason not performing, but you have the pressure? And now you are putting the pressure on the retailer. How does that work?
The idea is basically, when as a mall, our KRA or KPI is to maximize the revenue. Now, revenue is a function of the kind of trading density the particular brand is generating. If we are going to maximize the revenue, they have to maximize the trading density. If I keep, as a mall, increasing my revenue targets, I need to also doubly ensure that the brand is performing to their optimum level, that is the trading density, for which is a function of all the operational excellences which they have to follow. This external pressure helps them as a catalyst to be under a pseudo pressure so that they start performing.
Basically, danda, na? Not.
I think it's a very motivating way. We did it with one of the brands, and what happened before the PIP, they were at clocking 12 to 13 lakhs. After the PIP, they are clocking 25 lakhs. So they thanked us for the PIP as an instrument, but it is a more motivational rather than as a threat. Because the idea is that if the mall is not optimizing on the consumption numbers or not trending at optimization, we are as a mall also not able to maximize our revenue targets. Now, when I'm going to increase my rental revenues, at the same time, I want the brand to optimize on their sales performance, which means you need to have the right merchandise, right manpower, right VM, the right things at the right place. Because the brand has around 100 plus stores in the country. Now, in that particular mall will not be the only focus. So the idea is that how we can get into a collaborative exercise between the mall and the store, bringing the operations excellence, and you really need to do that daily exercise or a weekly exercise to balance both. Otherwise, if the mall continuously increases the occupancy cost without putting pressure on the trading density, the brands will say it is a one-sided, so we are not able to balance. So when we are putting pressure on the brand, why are you not able to show growth? Why are you not able to show? They appreciate that we are equally concerned because we want to maximize both the metrics.
Makes sense, yeah. But just one suggestion is just keep the targets out of reach but not out of sight. So, like 10, 15, 20%, like you said, is good enough. Rakesh, like you said, you had to do malls where you have higher premium centers like Fitness First and other bespoke ones. Now, obviously, you have to take a call because malls also come with a lot of extra cost, security, cam, and you obviously maintain that. Now, for you, is it not easy for you to kind of go and talk to the mall and say that I'm bringing in so much of this footfall? Because obviously there's a rev share model, I'm sure, but you also bring in a captive audience, which automatically goes and, because it's coming for you. It's like any FEC or a cinema. How does that conversation happen to you? Because you have very large centers, and if you pay the basic rents, which normally malls would do, you would never be able to break even. How do you manage that maths with them?
In our case, almost larger outlets are like from 10,000 to
10,000
27,000
square
square feet. So 27,000 square feet is the highest size we have. So of course, fitness first format wise, when it goes, it's a thing what we do. But at the same time, I'm thankful in some of wherever we are present. Correct, they are supporting, no doubt, and also they're giving any marketing support and all the things. Only challenge happens is when the entire mall's demography changes. Suddenly they will fix some doors. Suddenly some marketing tools they fix. Entire visibility will go off, and the signage whatever is given different. No, when you go to the mall again. Sorry to say, sometimes it's a very bureaucratic way of thing. Then you have to go to table again. So then that will actually enter. But wherever we got good support. But at the same time, some places rationally we took a stage that we discussed with these mall developers, like whether we can surrender some portion, which was kept as a luxury in our case, were not utilized. It's not a fair for each other. That's also done. But those things were happening. But if you ask me, currently, since almost past 1.5 years, there are a lot of developers who are coming to us. Now earlier the fitness was not an organized thing. Currently, since post-COVID, almost 70% organized fitness is managed by us. They are approaching proactively with the design stage itself, whether we can block, whether we can create this. This is helping.
Gotcha.
ROI is working really.
Okay, super.
Yeah.
So the ROI is coming through it. Oh, super. Sanjay, we've got just 2 more questions to go because we have a 7 o'clock in a bar waiting. Sanjay, because you've seen Bangladesh, you've seen Sri Lanka, obviously now you're part of an Indonesian company which is in Malaysia and Singapore, another. Where do you see in terms of the rev share kind of, let's say, metrics? Because, for the business that you are, you're a coffee brand, you're a coffee chain, and you also know that you are going to be competing on value. You can't go, high on, let's say, you would not go luxury in coffee, right? And you want to open 1,000, I'm sure. But how do you fit in? Because you see numbers coming in from other countries, which you've also been part of. Where does India fit? Let's say, if India is 10%, are they charging 15% or 5%? Where do you think? Is India overpriced, revenue share based?
So you actually said a statement which is fair, which is first word rent and third word sort of pricing / sales. Sales, I would still say that if you get it right, India still can give on a per unit basis. The sales still can do well, but it's a little brutal in nature, the market, right? So it chooses who does well and those who don't do well do not survive. So that is one part of it. From a revenue share standpoint, see, maths, I think depends. So maths, what happens is that in a place where there is a fairly high, let's say, revenue, so the brand also doesn't mind paying a higher rent. But it's not necessarily proportional in India is what I see. In some places, one is out of sync of the other. So there are, like when we make our ROI as per formats, they're very, very different. So a mall, I'll not take exact numbers, but a mall maybe, let's say, X break even, X number of years. For a similar sales, sometimes a high street can be 0.5x, 0.4x, right? And sometimes it can be the reverse as well. So I think the variation in India is far higher. Like if I go to Malaysia, Singapore, things are fairly standardized. You know, so people are rightfully demanding what is right in that sense, and the maths is much more transparent. I think here the variation is a bit high. Sometimes you get a great deal, sometimes you get the other side, the
So
wrong
basically,
side.
luck by chance, whatever, yeah? Sometimes
Yeah.
it works. Yeah, so welcome to India in their own way. That's the only thing. Neerav, okay, last questions, and then we just do a spot, single answer one. So ROI, obviously, in my case, I only look at ROI. If it doesn't work, I will shut the store. It's very simple.
Sure.
No love there. If it doesn't make money, it doesn't make money. Now, ROI is definitely kind of the metrics for our success because we invested that money in the brand as well as the product there and the capex that we put. Now, sometimes when you're so obsessed with it as a retailer, you basically are stifling innovation. You know, you basically just looking at your bottom line and then, you know, innovation takes a toss.
Yeah.
Where does your group of, let's say, brands fit in on the innovation cycle?
Sure. So I think as hypermarkets and supermarkets, right, we definitely have to focus on innovation, but it is not very high priority for us. I think if we as a business do the basics right, get our pricing right, get our assortment correct, and get stocks in the store when customers are there, I think that should do
What you're supposed to do.
pretty good
Yeah.
for our business. Innovation for us is not very important.
Got you.
In my previous organization, maybe in QSR, I think innovation is very
Obviously.
important. But in grocery retail, I don't think innovation actually comes up in probably the top 3 things that we are supposed to.
Got you. Okay, okay, super. I think you mentioned about marriage, right? You said it has balance. It's not a balance, it's a compromise. Marriage is never, you can't make 2 people happy, ever. So on that compromise, Akash will just go, quick question. Where do you compromise, ROI or trading density? Which one, are you the husband or the wife? Or both? I don't know, आजकल बहुत कुछ हो रहा है, so I have no idea.
I don't know what to answer, but between the two, I think the ROI matters the most with the investor,
Okay.
the shareholder, and if you really want to create wealth for everybody.
Okay, so ROI for you.
Yes.
So you'll compromise trading density. Arif?
ROI.
ROI,
hands
okay,
down.
super. We're talking about ROI for the retailer, right? Just to be.
Let me be clear, you know, trading density might be the most abused word, but that is what it is. So trading
Okay.
density is what
Okay,
matters for a
okay.
mall. Yeah.
2 plus 1, okay.
Yeah, for malls, I think trading density matters.
Okay, super. 2 plus 2.
Yes, ROI.
ROI,
It
okay. We
counts.
got 3 on 2. Sanjay?
Well, let me again try
In
to give
Indian
again a
context,
complex.
Indian
Tell
context.
me slightly. Still, I'll classify the answer. So see, a 10% cost at 10 lakh sales hurts more than a 15% cost at 30 lakh sales.
Ooh,
Okay.
okay.
So what I'm trying to say is, again, not one versus the other.
Yeah.
But if I necessarily have to choose, I have to choose ROI. You know, because
Okay.
that's what sustainability. That's a sustainable business,
Sure.
basically.
Okay. You know?
Yeah, I think same. If I had to choose, because I think both are extremely important, but if I had to choose, I would say ROI.
Okay. I think because the panel is biased because you're more
Yeah,
retailer. but
absolutely. Yeah.
Asking me, I'll choose trading density. Being a retailer, because I want more people to drink beer. It's as simple as that.
Sure.
I don't care. ROI will come. If you have trading density, so I have a very simple thing. I keep telling my people, I have only 2 metrics I do in my office for our revenues. We do APC, because we don't do APT. We do APC per cover, per person, into the number of covers, okay? Number of covers is the churn. McDonald's could churn 10 times, coffee could churn 20 times. I would probably churn 3-4 times. But APC is kind of, you can't increase the APC dramatically because there is a propensity for your pocket.
Correct.
There's a menu engineering and stuff, but it's all covers. I'm not saturated. We're open from 11 till 2 in the morning. I would just get as many people just coming and have a beer. We're not a lunch and dinner place. So I just look at one matrix now. APC, I don't care because I know it's already at a very good number. I just look at covers and churns. 550 chairs, so 50 I have to turn. And the only way it'll happen is when you have people on their foot and there's a toilet nearby. That's it. I just need 2 things. That's it. Foot and toilets, and we're good to go.
Fantastic.
So I'm a trading density fan.
Fantastic.
Okay, super. We end there. Mo.
Thanks, Rahul and the members.